Are you ready to start investing but don't know where to begin? You're not alone. Many people feel intimidated by the idea of entering the investment world. The good news is, it doesn't have to be complicated or risky. Today, we'll take a look at 8 beginner-friendly ways to start investing safely and confidently, from stocks like Apple and Tesla to cryptocurrency like Bitcoin and Ethereum. No need to be overwhelmed. These strategies are simple, effective, and designed to help you build wealth over time. Let's jump right in and start securing your financial future. 1. Start small and think long-term. When you're just starting out, it's completely normal to feel a bit cautious. But don't let that stop you from getting started. You don't have to invest large sums to begin. Start small, and you can still make meaningful progress toward your financial goals. Thanks to fractional share investing, you can invest in companies like Apple, Amazon, or even Tesla, even if their stock price is out of your range. With fractional shares, you can buy as little as a fraction of a share. Imagine buying just $50 worth of Tesla stock or $20 worth of Amazon stock. It's a great way to start, and your investments can grow over time if you keep a long-term perspective. Just like Bitcoin and Ethereum, which have seen massive gains over the years, your small investments can potentially appreciate significantly over the decades. Remember, investing is about consistency, and starting with small amounts means you have less risk with more opportunities for growth. Even if you only buy one fractional share now, it can grow with time, just like the value of Bitcoin in the past decade. 2. Diversify your portfolio. As you start building your investments, one of the most important principles to understand is diversification. Instead of putting all your money into one asset like Tesla, spread your risk by investing in a range of assets. Diversifying your portfolio could mean buying stocks in different industries, such as tech, healthcare, or energy. You could invest in Amazon for retail, Apple for tech, and add some Bitcoin or Ethereum for exposure to cryptocurrency. Index funds, like the Vanguard Total Stock Market ETF, VTI, allow you to diversify even further, as these funds pool money to invest in a broad array of assets. The idea is simple. If one asset goes down, others might go up, which reduces the overall risk. You don't need to be a financial expert to diversify. By using ETFs or index funds like SPY, which tracks the S&P 500, you can get exposure to some of the largest companies in the US all at once. Diversification is one of the easiest ways to safeguard your money while growing your wealth. 3. Invest in what you know. One of the smartest strategies for beginners is to invest in industries or companies you already know and care about. You don't need to become an expert in every industry to invest. Just stick to what you're familiar with. If you love video games, consider investing in gaming companies like Activision Blizzard or Electronic Arts. If you follow the electric vehicle EV revolution, why not consider investing in companies like Tesla or Rivian? This strategy can extend to cryptocurrency too. For example, if you've been reading up on blockchain technology, investing in Bitcoin or Ethereum might feel more comfortable since you already understand how they work. You can even make it fun. Imagine how excited you'd be to invest in a company or technology you're passionate about and see it grow. By investing in what you know, you'll stay more engaged and motivated to keep learning about your investments, making it easier to track progress and make informed decisions. So whether it's Apple or Ethereum, your knowledge gives you an edge. 4. Consider index funds and ETFs. For beginners, index funds and ETFs, exchange-traded funds, are perfect starting points. These financial products pool money from multiple investors to buy a basket of assets, such as stocks, bonds, or commodities. Popular examples are SPY, which tracks the S&P 500, and VTI, which tracks the entire US stock market. These funds automatically diversify your portfolio, making it an easy and low-cost way to start investing. You could also look into ETFs that focus on specific sectors like the Invesco QQQ ETF, which targets tech stocks like Apple, Microsoft, and Google, or even a blockchain ETF for exposure to cryptocurrency companies. Index funds and ETFs are especially attractive because they typically have low fees, making them perfect for beginners. By investing in these funds, you can achieve instant diversification without having to research each individual stock. Plus, these funds often perform better over time than trying to pick individual winners. 5. Implement the dollar-cost averaging approach. The dollar-cost averaging (DCA) strategy is a great way to reduce the emotional stress of trying to time the market. With DCA, you invest a set amount of money at regular intervals, regardless of whether the market is up or down. This approach works wonders, especially in volatile markets like cryptocurrency, where prices can fluctuate dramatically from day to day. For example, you could choose to invest $100 every month into a combination of stocks like Tesla and Apple, and maybe even a little into Bitcoin or Ethereum. The beauty of DCA is that it smooths out market fluctuations. Sometimes your $100 will buy more shares when the price is lower and fewer when the price is higher. Over time, this strategy helps reduce the impact of market volatility on your overall investment portfolio. By automating your investments with DCA, you'll build a habit of investing regularly, which can lead to substantial wealth over the long term. Plus, you don't have to worry about making emotional decisions based on short-term market movements. 6. Keep an eye on fees. When you start investing, it's easy to overlook the impact of fees on your returns. High fees can eat into your profits, especially over time. Whether you're investing in stocks like Amazon or Ethereum, or buying an ETF, make sure to check the fees involved. Brokerage fees, fund management fees, and trading commissions can all add up, so always be aware of the cost of your investments. Look for low-cost brokers that offer commission-free trading, such as Robinhood or Fidelity, and choose ETFs and index funds with low expense ratios. The Vanguard Total Stock Market ETF, VTI, for example, has a very low expense ratio, which is ideal for long-term investors. You don't need to sacrifice quality for low fees. Many robo-advisors, like Betterment, offer fee-free access to diversified portfolios that you can adjust according to your risk tolerance. By minimizing fees, you can maximize your returns over time. 7. Rebalance your portfolio regularly. Investing isn't a set-it-and-forget-it strategy. Your portfolio needs to be checked and rebalanced periodically to ensure it aligns with your financial goals. For instance, if Tesla stock has performed really well, it might now make up too much of your portfolio. Rebalancing involves selling off some of your overperforming assets and buying more of those that have not grown as much, like Apple or even a few bonds. As your portfolio grows and your financial goals evolve, you may want to adjust your risk level. If you feel comfortable taking on more risk, you could sell some of your lower-risk investments like bonds or money market funds and shift that money into stocks or ETFs for higher potential returns. But always make sure the changes match your long-term goals. Rebalancing is a great way to ensure you're not too exposed to one type of asset, especially in volatile markets. It helps you maintain the right balance between risk and reward as you work toward your financial goals. 8. Stay informed and keep learning. The world of investing is always changing, so it's important to keep learning and stay informed. Whether it's reading the latest news about Bitcoin or understanding trends in the stock market, keeping up with what's happening in the financial world can help you make more informed decisions. Take advantage of educational resources like podcasts, online courses, and financial blogs to deepen your understanding of investing. Greenlight, for example, offers a great educational app where even kids can learn about investing in a safe and supervised way. The more you learn about investing, the better equipped you'll be to make smarter decisions with your money. Staying informed also helps you adapt your strategy as the market evolves. For instance, if you notice a surge in cryptocurrency interest, you might want to increase your investments in Ethereum or Bitcoin. Or, if interest rates rise, you may want to shift from stocks to bonds. That's it for today. 8 beginner-friendly ways to start investing safely and confidently. Whether you're just starting with small amounts, diversifying your portfolio, or using dollar-cost averaging, these tips will set you on the right path toward building wealth over time. If you enjoyed this video and found it helpful, don't forget to like, share, and subscribe for more personal finance tips. Thanks for watching, and remember, investing today is investing in your future. See you next time.